REIT's annual results demonstrated a strong operational performance. The group achieved a standout occupancy rate of 97%, driven by resilience and strategic growth initiatives. Earlier, I unpacked the numbers and discussed what the future holds for the company with CEO Quinton Rossi.
Yes, good evening, Zanati, and good evening to your listeners. The FY25 financial year was certainly a transformative year for us. Spear grew its portfolio by in excess of 1.15 billion in assets across the Western Cape of around 93,500 square meters. We also saw about a 20% increase in our portfolio value towards the end of FY25, in addition to about a 3.57% increase in our tangible net asset value per share, driven by improved property values, printing a 3.08 growth in a distributable income per share for FY25. So the key takeaway here was asset value growth, portfolio optimization and expansion, together with achievement of very good top-line revenue growth and net profit growth for the year.
You talk about that acquisition worth over 1 billion rand, of course, those 13 assets that you acquired from Emira. How has the financial impact looked so far, both from an income point of view and also cost?
Very positively. We have actually tracked slightly better than the budgeted forecast that we put out in the Category 1 transaction. Given the fact that shareholders were highly supportive of the transaction, we were actually able to raise quite a substantial amount of money in the last financial year, which in the region of about 560 million, which allowed us to reduce our LTV to such an extent where we've closed off the financial year at a far lower LTV than what was projected in the Category 1 transaction. The Category 1 transaction projected about a 34% LTV. We closed off the year at 27%. So from a financial metrics cost of debt perspective, our finance costs post the transaction declined by 24%. Our growth in portfolio value and also the quality of the portfolio has also improved our debt margins with the banks as the quality of the portfolio consistently improves, and the scale does give us that much more negotiation power with the banks.
Yeah.
And in terms of leases, there were some asset management opportunities that we have taken advantage of, in particular in some of the office locations that have proven to print out better than expected rental rates per square meter. And also the initial portfolio that we acquired from Emira had about just under 7% escalation rate. We now slowly but surely massaging that escalation rate up to where we would see a standard being around 7.27 to 7.3%. So that's been positive. Because we are fully internally managed REIT, the portfolio we acquired used to be externally managed. So we have created some economies of scale by internalizing that portfolio and also utilizing our supplier network to give us some advantages from a negotiation of overheads on the day-to-day running of that portfolio.
All right. Quinton, talk to me about the level of demand and occupancy that you're seeing in your different property classes.
We are very happy that on a financial year to financial year in every one of our subsectors, retail, commercial and industrial, we've seen an improvement in occupancy levels. We continue to see demand across our asset types. In particular, in the last 6 months of this financial year ending at 28 Feb, was the office sector. We saw a improvement from the prior financial year of about 84% occupancy to just under 93% occupancy. In terms of industrial, because of the attractive location of our industrial portfolio, we've consistently operated with a very high occupancy rate. And also one of the reasons why it's 63% of our gross settable area is our industrial portfolio, which also happens to have the strongest in-force escalation rate passing through, which also contributes to positive top-line revenue growth. And in the retail subsector, which is still a part of the portfolio, it's valued at under 1 billion rand.
Okay.
We are doing a lot of work to try and grow that portfolio, but we also value investors. We saw a more than double inflation growth in rent reversions positively for that subsector, which again just talks to the demand that larger retailers are placing as they release more capex for stores to go larger, to be in more locations, to gain more market share. So overall, the health test is very, very strong, and it's a fit portfolio, and it's a portfolio that's primed for growth.
You talk about wanting to grow the retail portfolio and just drilling into your overall portfolio expansion. Paint a picture of that runway and what will drive your decisions in the assets that you choose.
So post the most recent acquisition we announced yesterday for the Burger River Business Park in Paarl, post that acquisition, we'll probably have about 2.3 billion rands worth of industrial assets, 2.3 billion of commercial assets, and about 990 million rands worth of retail assets. So the focus really is to kind of get a bit more diversification in the retail space. So there is work underway. We've got about R1 billion acquisition pipeline we're working on at the moment, of which a big portion of that would be exposure to retail, which would be very complementary to the portfolio. But again, also, it has to meet our strict investment criteria. So from a portfolio composition perspective, we see the entire Western Cape as an investment opportunity across asset types. Just given the constraint in supply, the shortage of available and zoned land, the beauty of our investment approach is that we can be investors across those asset types and still add value as long as these are yield-enhancing assets.
Well, we do have to wrap up the conversation there, but thank you so much for your time and detailing those numbers for us, Quinton. I always appreciate your time. That was REIT CEO Quinton Rossi.